Every crisis is supposed to reset the system. That is the story we are told. When markets collapse, when currencies weaken, when companies fail and people lose their jobs, the assumption is that everyone is pulled down together. That loss is shared. That pain is distributed evenly across society. Crisis, in this narrative, is chaos, unpredictable, random, unfair, but temporary. And yet, there is an uncomfortable pattern hiding in plain sight. After every major crisis, when the dust settles and the headlines fade, the same names appear at the top. The same institutions emerge larger. The same balance sheets grow heavier. The same group quietly accumulates what others were forced to give up. This raises a question that almost no one asks out loud. If crises are accidents, why do their outcomes look so consistent? If collapse is disorder, why does it produce such orderly winners? And if every crisis makes the same people richer, at what point does coincidence stop being a convincing explanation? What follows is not a story about corruption, greed, or moral failure. It is not a claim that crises are secretly orchestrated, nor that individuals sit in rooms planning collapse. That explanation is too simple, and it lets the real structure remain hidden. The truth is more unsettling precisely because it does not rely on villains. It relies on design. Crises do not redistribute wealth upward by accident. They do so because the system that governs modern economies is built to behave that way under stress. In normal times, this structure is invisible. Growth hides it. Stability masks it. Rising wages and expanding credit create the illusion that opportunity is broadly shared. But when pressure enters the system, when liquidity dries up and confidence breaks, the underlying mechanics are exposed. At that moment, rules that seemed neutral reveal their bias. Access to capital becomes the dividing line between survival and collapse. Assets that once felt secure are suddenly repriced. Debt does not disappear. It tightens. And while most participants are forced to sell, retreat, or absorb losses to stay alive, a smaller group is positioned to do the opposite. They are not reacting to crisis. They are absorbing it. This is why the same outcome repeats across different eras, countries, and triggers. The crisis itself can be financial, political, medical, or technological. The cause can change. The winners do not. That consistency is the signal. It tells us we are not looking at failure, but at function. The system is not breaking. It is doing exactly what it was built to do under stress. To understand why crises enrich the same people every time, we have to step away from individual events and look at the structure that connects them. Not what happened, but why it had to happen this way. To see this structure clearly, we have to return to a time before modern markets felt inevitable, to a period when crisis still appeared genuinely destructive, not just to people's lives, but to the foundations of power itself. In the late 19th and early 20th centuries, economies were far less financialized than they are today. Wealth was concentrated, but it was often tied directly to land, factories, railroads, and physical production. When a panic occurred, when banks failed or credit evaporated, even the powerful could fall with surprising speed. The Panic of 1873, the Panic of 1893, and later the crash of 1929 did not initially look like opportunities. They looked like endings. Businesses collapsed, fortunes evaporated, unemployment surged, and social unrest followed. In the early stages of these crises, no one believed they were mechanisms for enrichment. They were perceived as breakdowns of order. Governments were weaker. Central banks were either non-existent or limited, and markets were more exposed to raw fear. But it was precisely this instability that revealed a critical problem for those at the top. Total collapse was dangerous. If too much failed at once, the system itself could fracture. Political legitimacy would erode. Social unrest could spill into revolution. Wealth concentration, left unmanaged, could destroy the very structures that protected it. What emerged from these realizations was not a conspiracy, but a gradual redesign. Over the 20th century, economies were rebuilt around a new principle: Crises would no longer be allowed to fully destroy capital. They would be contained, redirected, and absorbed. Institutions would be created to stabilize markets not for fairness, but for continuity. Central banks expanded their role. Financial markets grew deeper and more interconnected. Governments learned to borrow, intervene, and backstop the system when fear threatened to spiral out of control. This transformation did not eliminate crises. It changed their function. Instead of wiping out the top along with the bottom, crises became filters. They separated those with access to liquidity from those without it. Small businesses, households, and lightly capitalized firms remained exposed to downturns. Large institutions, diversified portfolios, and entities with political and financial connections were insulated, not from volatility, but from extinction. By the mid-20th century, this structure had hardened. The Great Depression led to reforms that appeared to restrain finance, but they also formalized its central role. Bretton Woods, central banking, deposit insurance, and later the expansion of global capital markets created a system where losses could be socialized while gains remained private. The language used was stability. The effect was asymmetry. From that point on, every crisis would unfold within this redesigned architecture. Panic would still arrive. Jobs would still disappear. Assets would still fall in price. But the question was no longer whether wealth would survive. It was whose wealth would be positioned to grow once the collapse forced others to retreat. This is the environment in which modern crises operate. Not as random shocks, but as stress tests built into the system itself. What separates those who grow richer during crises from those who are destroyed by them is not foresight in the mystical sense, nor superior intelligence in the abstract. It is position, more precisely. It is proximity to the mechanisms that control liquidity, pricing, and survival. When normal market rules are suspended, as financial systems evolved through the 20th century, a distinct class of actors emerged. They were not necessarily the most productive or innovative. They were the ones closest to capital flows, policy decisions, and market infrastructure. Bankers, large asset managers, institutional investors, and later multinational corporations learned something fundamental that most participants never did. In a crisis, the rules change, but not randomly. They change in ways that favor scale, access, and patience. These actors did not need to predict the exact timing of crises. They only needed to understand that crises were inevitable, and that when they arrived, liquidity would become the most valuable asset in the economy. When fear dominates, prices do not reflect long-term value. They reflect urgency. Those who must sell do so at any price. Those who can wait become buyers of last resort. Over time, this understanding shaped behavior long before any crisis appeared. Large institutions structured themselves to survive, downturns by design. They diversified risk across markets and geographies. They maintained access to cheap credit. They cultivated relationships with regulators and governments, not to break rules, but to ensure they were not excluded from emergency support when the system came under stress. This positioning was not hidden. It was normalized. Central banks openly declared that their role during crises was to provide liquidity, stabilize markets, and prevent systemic collapse. But systemic collapse never meant the collapse of every participant. It meant the collapse of those whose failure would threaten the structure itself. Size, interconnectedness, and leverage became forms of protection. The result was a quiet but profound shift. Survival itself became uneven. Some entities entered crises knowing they would be supported, directly or indirectly. Others entered knowing they were alone. This asymmetry did not guarantee profit, but it guaranteed opportunity. And opportunity, when combined with scale, reliably turns into accumulation. By the time the late 20th century arrived, the architecture was complete. Crises were no longer moments when the powerful feared losing everything. They were moments when the powerful prepared to absorb what others could not hold on to. At this point, the question is no longer who benefits from crisis, but how the system converts widespread loss into concentrated gain. A crisis does not create wealth for anyone by itself. What it does is force movement. IT compresses time, accelerates decisions, and removes the option of waiting for most participants. This is the first and most important mechanism. Under normal conditions, people can hold assets, delay choices, refinance debt, and wait for prices to recover. Crisis removes that flexibility. Cash flow becomes survival. Time disappears. When this happens, the economy splits into two groups: those who need liquidity immediately, and those who already have it. The first group sells. They sell homes, businesses, stocks, land, and future income streams not because they want to, but because they must. The second group does not need to sell anything. They become buyers, not because they are optimistic, but because they are patient. The second mechanism is repricing under distress. Prices during crises do not fall because assets suddenly lose their usefulness. Factories still produce. Companies still have customers. Land does not vanish. Prices fall because sellers are forced to accept whatever the market will give them. This is not a correction based on fundamentals. It is a transfer driven by urgency. Whoever controls liquidity controls the terms of that transfer. The third mechanism is policy response. When fear threatens to spread beyond markets into the real economy, governments and central banks intervene. Interest rates are cut. Credit facilities are opened. Asset purchases begin. These actions are described as neutral stabilization tools, but their effects are not evenly distributed. Support flows first and most directly to financial institutions, capital markets, and large corporations. Households and small businesses receive help later, if at all, and often in more restrictive forms. This creates a feedback loop. As assets fall, institutions with access to cheap capital buy them. As policy stabilizes markets, asset prices recover. The gains accrue to those who bought during the panic, not to those who sold to survive it. Losses are absorbed by individuals and small entities. Recovery enriches those positioned closest to the channels of intervention. The fourth mechanism is consolidation. Crises weaken fragmented actors and strengthen centralized ones. Small firms disappear or are acquired. Independent competitors are absorbed by larger platforms. Market share concentrates not because of innovation, but because resilience favors scale. Every crisis reduces the number of players and increases the dominance of those who remain. The final mechanism is memory loss. Once stability returns, the narrative resets. The crisis is framed as an unfortunate shock. Recovery is celebrated as proof of resilience. Asset inflation is described as growth. The structural transfer that occurred under pressure fades from attention, but the balance sheets remain changed. Ownership is more concentrated. Control is more centralized. And the system is more prepared for the next cycle. Together, these mechanisms explain why outcomes repeat, even when causes differ. Crises are not equalizers. They are filters. They move assets from those who need flexibility to those who can afford patience. They convert volatility into ownership, and they do so without requiring coordination. INTENT, or conspiracy. The structure alone is enough. Once you understand the mechanism, individual crises stop looking unique. They begin to blur together. Different decades, different triggers, different headlines, but the same structural outcome, repeating with remarkable precision. This is not because history lacks creativity. It is because the system does not change its logic when it is under stress. The Great Depression is often remembered as a moment when capitalism nearly destroyed itself. What is discussed less is what followed. Asset prices collapsed, not only for speculators, but for ordinary owners of land, businesses, and shares. Those who were leveraged lost everything. Those who held cash, access to credit, or political connections did not. As recovery took hold, ownership was far more concentrated than before. The crisis did not democratize wealth. IT reorganized IT. The inflationary crises of the 1970s followed a different path, but ended in the same place. Rising prices destroyed savings and wages in real terms. Debt holders benefited as obligations were repaid with cheaper money. Asset owners protected themselves. By the time stability returned, purchasing power had shifted upward. Those dependent on income fell behind. Those dependent on capital did not. The financial crisis of 2008 made the pattern impossible to ignore. Yet it was quickly forgotten. Housing collapsed. Millions lost their homes. Small banks failed. Retirement accounts were wiped out. At the same time, large financial institutions were rescued. Liquidity was injected directly into markets. Asset prices rebounded rapidly, while employment and wages recovered slowly. Within a decade, wealth inequality reached historic extremes. The crisis did not break the system. It clarified who it was built to protect. Even crises that appear external follow the same structure. The pandemic was framed as a health emergency, not an economic one. Yet the economic outcome was familiar. Small businesses closed permanently. Workers absorbed income shocks. Meanwhile, asset prices surged. Stock markets reached new highs. Technology platforms expanded their dominance. The same concentration occurred under a different justification. These examples are not anomalies. They are confirmations. Different names. Different circumstances. The same structural behavior. When pressure rises, flexibility becomes power. When liquidity becomes scarce, those who control it accumulate. When intervention arrives, it stabilizes ownership, not access. History is not showing us that crises are unpredictable. It is showing us that outcomes are. Once you see the pattern, it becomes impossible to confine it to the past. It stops being something that happened to other people in other eras and starts revealing itself in ordinary decisions made every day. The pattern is not hidden in textbooks or crisis timelines. It is embedded in how modern life is organized. Look at how people experience instability today. When uncertainty rises, the first response is not strategy. It is survival. Households cut spending, drain savings, take on debt, sell assets, or postpone long-term plans. Small businesses reduce staff, close locations, or shut down entirely. These actions are rational. They are necessary. They are what the system forces when cash flow becomes fragile. At the same time, markets react very differently at the top. Volatility creates opportunity precisely because it creates forced sellers. Large pools of capital do not experience uncertainty as paralysis. They experience it as mispricing. When assets fall quickly, it is interpreted not as loss, but as access. The same event that destroys stability for one group creates entry points for another. This is why asset prices often recover long before daily life does so. Stock markets rebound while wages stagnate. Real estate prices rise while homeownership becomes less attainable. Entire industries consolidate while employment within them becomes more precarious. The recovery is real, but it is selective. It restores valuation, not security. Technology has accelerated this process without changing its logic. Platforms with scale absorb competitors during downturns. Access to capital markets allows losses to be endured until conditions improve. Smaller participants do not have that luxury. They are optimized for efficiency, not endurance. When stress arrives, efficiency becomes fragility. Even public support reflects this asymmetry. Emergency programs are framed as universal, but access is uneven. Credit flows through institutions before it reaches individuals. Asset stabilization precedes income stabilization. By the time relief arrives at the edges of the system, ownership has already shifted. The moment has passed. What makes this difficult to accept is not the mechanics, but the narrative. People are told that outcomes reflect effort, discipline, and choice. When crisis arrives, failure feels personal, but the pattern suggests something colder. Outcomes reflect position within the structure. Effort determines how hard the fall feels, not whether the fall occurs. This is the present-day mirror of every crisis before it. The same logic operating faster, deeper, and with greater reach. The question is no longer whether the pattern exists. It is how long it can remain unseen. At this point, the instinctive reaction is to look for an exit. If the system produces the same winners every time, then there must be a way to step outside it. That is the comforting thought. But comfort is not the same as accuracy. There is no clean escape from a structure that organizes the entire environment in which decisions are made. You cannot opt out of liquidity cycles if your income depends on cash flow. You cannot avoid asset repricing if your savings are denominated in systems that reprice under stress. You cannot fully detach from institutions that mediate credit, employment, and exchange. The system is not something you occasionally interact with. It is the medium you move through. Some respond by trying to resist it. They reduce exposure, avoid markets, distrust institutions, and seek stability in isolation. This can reduce volatility, but it also limits opportunity. Others try to align with it, believing that proximity to capital is the only rational response. This can offer protection, but it also deepens dependence on the same mechanisms that create fragility elsewhere. Most people live somewhere in between, adapting as best they can without fully understanding the forces shaping the outcomes. That is not a failure of intelligence or effort. It is the natural position of individuals inside a system designed at scales far beyond personal control. What matters here is not choosing the correct response, because there is no universally correct response. What matters is abandoning the idea that crises are moral tests or personal judgments. They are structural events. They reward certain positions and punish others regardless of intent. The danger of believing in simple exits is that it keeps attention focused on tactics rather than structure. As long as the system remains unchanged, the pattern will repeat. Different crisis, same outcome. Every crisis eventually ends. Markets stabilize. Headlines move on. New growth narratives take their place. From the outside, it looks like recovery. But underneath that surface, something permanent has shifted. Ownership has changed hands. Control has concentrated. The system has become more resilient for some and more fragile for others. Not because anyone intended it that way in the moment, but because the structure channels stress into the same outcomes every time. This is why asking who caused a crisis often misses the point. The more important question is why the aftermath looks so familiar. Why the same institutions emerge stronger. Why the same balance sheets expand. Why the same group quietly accumulates what others were forced to release. Crises feel exceptional while they are happening. In hindsight, they look routine, not because they are harmless, but because the system has learned how to metabolize them. Loss becomes input. Volatility becomes opportunity. Fear becomes leverage. Once you see this, it becomes difficult to return to the comforting belief that collapse is random or that recovery is neutral. The pattern does not care about intentions. It does not respond to fairness. It responds to position. You cannot stop crises from coming. You cannot make them distribute pain evenly. And you cannot rely on effort alone to shield you from their effects. But you can recognize that when the next one arrives, it will not rewrite the rules. It will reveal them. And that realization changes the story, not because it offers certainty or safety, but because it removes illusion. Crises do not make the same people richer by chance. They do it because the system was built to work that way.